Here we are again, deja vu. Welcome to another Beers with Rich. I'm Rich, editor here at Under the Radar Report. Got a particularly good one this week, I think. Well, partially because the beer that caught my eye, because of its packaging. I actually thought it was a Coke, but it's not. It's Two Bays, Two Bays Brewing Big Red IPA. Well, the name alone got me, but also that it's apparently it's a craft beer, so it's called a batch beer, and that means they do a different batch every month or so just to keep people interested. So here we go, Big Red. What's next? Big Blue? Who knows? It's quite rich, bit fruity. Pretty good. I'm starting to, use my tongue a bit more when discerning the taste. Really, it's beer. But this is a practical way boozers can diversify. Because you've got a new set of boozers every month from the same brewer. So that's what I like about small caps, is the diversity of choice. And that's the theme for today. Well, just excuse me while I taste another Big Red. It's actually Victorian, so they probably need them a lot. Anyway, I keep banging on about the big learning of the past 50 years for those sort of wonks like me that are interested in the economics and the finance of investing. But it's been the value of diversification that's made the biggest difference to returns. The fact is, you cannot effectively diversify your portfolio and reduce your risk if you don't include small caps. It's just the way it is. Why is that? Well, small caps aren't part of the ASX 200, which is the market basically. So because they're not part of the ASX 200, they're not included in the general returns of the market. So they're not correlated. So that's one big reason. The other is that small caps are pretty much the most cost-effective way, and for many of us, the only way of accessing the future, other than obviously by watching Back to the Future, the film series. Basically 10 years ago, had we heard of Afterpay? 10 years ago, did people even hear the phrase buy now, pay later? I mean, it wasn't even in the lexicon. Have we heard of lithium? Other than people suffering from mental health. Had we heard of electric vehicles being the future? No, we hadn't heard that AI was going to take off. Did we think nuclear energy was a viable option? All these things change, so they really do, and you have to be 2 steps ahead to be an effective investor. And that's what we spend a lot of our time doing, and that's what we've done with the 10 new best buys that we did this week. So it's pretty exciting. These stocks are in businesses as diverse as e-commerce, marketplace, workplace management solutions. That's more than just wearing ankle tags, let me tell you. Engineering, potash mining, energy, medical technology, recruitment, telecommunications, electric vehicles, they're all in there. All these little companies could be the Afterpays of tomorrow. But the key, another question, that we've got in terms of diversification is how many stocks you should own. Since I've been doing this, people have always been asking that question. Let me tell you one thing before I have another sip. Well, I'll have another sip and then tell you. 7 is the magic number. There you go. You heard it here on Beers with Rich. But really, 7 is just a starting point. So you get it, studies have proven you get as much as half your potential diversification benefits from owning 7 stocks. Basically, every stock has what they call stock-specific risk and market risk. And when you blend their risk curves together, that market risk is reduced. And it's optimally at 7 stocks. There's other ways in terms of mathematics that 7's important, but in the stock market, that's pretty much it. But that's not much compensation I found when I was first investing when one of your stocks falls out of bed. That is basically, you don't think, oh wow, I'm diversified, so that must make it all right. No, it hits hard. Emotionally, and I mean, that's a pretty important part of investing, as we all know, I think 15 stocks is about right. You get to be on 20, that's too many. Like, too many to keep on top of if you've got a full-time job. Let's talk about a couple of stocks. First up, I just want to talk about Alumina, which is a blue chip. I mean, this stock has rocketed 30%, so our blue chip portfolio manager is really happy, Sam Ferraro. This stock's climbed 30% because there's been a coup in Guinea disrupting supply. What we really like, the supply of bauxite, which goes to producing alumina and aluminium. But there's also big demand for aluminium. So what we like about this stock is the massive amounts of cash flow it's churning. The massive free cash is, which is the cash before, which goes into paying dividends. So this is what you want from a blue chip. You want income. And this is why Alumina is still, even despite its big rise, is still one of our favorites. I mean, you could say the same about Rio Tinto and BHP. BHP has more diversification, so lower risk, arguably. But iron ore is the key for both those stocks. And this week we do a pretty good analysis on iron ore and why it's fallen 40% in 3 months, but why we're still pretty confident about the future. I'll give you one little hint. Beijing Olympics, Winter Olympics coming up. China, they don't want pollution. They want to clean up their place. So that's a big reason why there's been a reduction in steel production. So what are you looking for from small caps? Obviously, if you've listened to me, growth. One company that we think is a quality company and getting growth is Hansen Technologies. We were big buyers of this company. It was on our best buys list, but then it got taken over. Well, it didn't get taken over. It got made a takeover offer by private equity. This company does software for specialized billing systems. So it really does cater to the big end of town. But those private equity guys just basically took their interest away. And now the stock's gone from $6.30, where we were taking profits, to around $5.55. Now, I think that goes to show the importance of taking profits when there's something on the table. Like, you never take anything for granted in the stock market. Here's to not taking anything for granted. Another excuse for a beer. But now at $5.55, it looks much better value, so we'll be doing some work. I mean, obviously, private equity got cold feet for a reason. And remember, the stock was trading at $4 when it was on our best buys list, as recently as early to this year. So it's been a big rise. It's a quality company, one worth looking at. Another one that's gone up that we've just taken off our best buys list is Infomedia. I mean, these guys do kind of car parts catalogs, so they're a media company of some description. Basically, it's a niche business that has a global franchise. So what I like about it is it generates subscription revenues. I mean, these are recurring revenues. So, I mean, there is some clunkiness to it. When it does have some big customers, if one of those customers takes their business away, there's risk. But I think this company is really essential in its sphere. So that's why I think it's still good value. I mean, it's a small cap with global presence. That's what we like. What's coming up? Let's look at what's coming up. We're in the middle of our festival of tens. That's what you do when you've been around for 10 years. You just think in tens. So we're coming up with lots of stocks that are future facing, as BHP would say, as well as lessons for managing your portfolio. More along the lines of what I've just been talking about, 7 stocks, 15 stocks, 20 stocks. We get down and dirty and we talk in detail about portfolio management. Plus, we look at what proportion of growth and income you need in your portfolio. So there's a lot coming up. It's exciting times. As always, here's to you. Great being a part of your Friday. I hope you're having a good one.